The dream of homeownership is something that many people share, but the question that often arises is, how much home can you actually afford based on your salary? In today's real estate market, things are far more complicated than just calculating a mortgage payment. With high prices, rising interest rates, and a multitude of other costs associated with owning a home, it's crucial to understand the full picture of what homeownership entails. Let's take a closer look. Please hit subscribe button for more informative videos. The difference between renting and buying. One of the most fundamental aspects of housing expenses is understanding the difference between renting and buying a home. When you rent, the monthly payment is fixed, and it remains the same for the duration of your lease. That's the advantage of renting. It's predictable and, in some cases, cheaper than buying. But that doesn't mean renting comes without challenges. When you own a home, however, things get a little more complicated. You still have the monthly mortgage payment, but that's only the beginning. Let's break down the other factors you'll need to consider as a homeowner. Mortgage. This is the amount you pay monthly to your lender. If you have a fixed-rate mortgage, this will remain the same for the length of the loan. Property taxes. These taxes are usually assessed annually, based on the value of your property. Rates vary depending on where you live, but they typically range from 0.4% to 2% of the home's value. Insurance. Lenders require you to have homeowners insurance, which covers potential damages to your home. Repairs. Homeownership comes with the responsibility of maintaining and repairing the property. Whether it's fixing an HVAC unit, repairing a roof, or addressing plumbing issues, the costs of upkeep can quickly add up. Other expenses. These include things like HOA fees, landscaping, cleaning, and upgrades. While some homeowners may not have these expenses immediately, they often crop up over time. Because of these additional expenses, owning a home is often more expensive than renting, and it can significantly impact how much home you can afford based on your income. How much you should spend on rent. Let's start with renting. The general rule of thumb is that your rent should not exceed 30% of your gross monthly income. For example, if you earn $40,000 a year, your rent should not exceed $1,000 per month. If you earn $80,000 a year, your rent should be $2,000 per month. If you earn $160,000 a year, your rent should be $4,000 per month. However, the 30% rule has been challenged in recent years, especially in high-cost areas where rent often consumes a much larger portion of a person's income. If you want a more flexible and holistic approach, consider the 50-30-20 rule for budgeting. This rule suggests that 50% of your post-tax income should go toward essential expenses like rent, food, and transportation. 30% should go toward discretionary expenses like travel, entertainment, and hobbies. 20% should be saved or used to pay down debt. The 50-30-20 rule takes into account not just rent, but all aspects of your finances, ensuring that you have a sustainable financial plan. Still, if you're sticking to the 30% rule, let's say you want to rent a home that costs $2,800 per month. In that case, you should make between $110,000 to $170,000 per year. The prices will vary depending on the location, but for homes in high-demand areas like New York or California, the numbers could be much higher. How much you should spend on buying a home. When it comes to buying a home, the guidelines are a bit different. Several rules help determine how much home you can afford, the most common being the 28% rule. This rule suggests that you should spend no more than 28% of your gross monthly income on your mortgage payment, which includes both the mortgage principal and interest, as well as property taxes and insurance. For example, if your gross monthly income is $5,000, your mortgage payment should not exceed $1,400 per month. The 30-33 rule. If the 28% rule seems a bit restrictive, you might want to try the 30-33 rule, which is often used by financial experts. This rule breaks down into three main guidelines. 30% mortgage rule. No more than 30% of your gross monthly income should go toward your mortgage payment, including taxes and insurance. 30% in savings. You should aim to have at least 30% of the home's value in cash or semi-liquid assets before making a purchase. 3 times annual salary. The home you buy should cost no more than 3 times your annual salary. For example, if you make $75,000 a year, you should keep your home purchase budget to $225,000. If you earn $150,000 a year, your budget would be $450,000. If your salary is $200,000, your home price budget should be around $600,000. The 30-to-33 rule is considered a more conservative approach, ensuring you don't overextend yourself financially. This rule can especially come in handy for those living in high-cost areas like California or New York, where the cost of housing far exceeds the average person's salary. What lenders look at. When you apply for a mortgage, lenders primarily consider 2 factors: your income and your debt-to-income (DTI) ratio. Income. Lenders will review your income to ensure that you have stable, verifiable earnings. Most lenders will require 1 to 2 years of tax returns and proof of steady employment. Debt-to-income ratio. This ratio calculates how much of your income is going towards servicing existing debt. Most lenders prefer a DTI ratio of 43% or lower. For instance, if you earn $8,000 per month, your total debt payments, including the mortgage, should not exceed $3,600. Should you rent or buy? As the housing market fluctuates, it's important to evaluate whether buying is the best choice at the moment. Currently, in many cities, renting is often more affordable than buying. According to Redfin, the typical home costs 25% more per month to own than to rent. If you're not in a hurry to purchase a home, renting may provide more flexibility and financial room to grow your savings. That said, if you're set on buying a home, be sure to shop around for lenders to get the best interest rates. Look for homes in areas with growth potential, and ensure that you have enough savings to cover the additional costs of homeownership. Homeownership is a significant financial commitment, and determining how much home you can afford depends on several factors. From understanding mortgage payments and taxes to considering repairs and insurance. Buying a home is far more complex than simply choosing a property you like. It's important to budget carefully, stay within recommended guidelines, and plan for the long term. Whether renting or buying, the key is to make sure that your housing costs don't stretch your finances too thin. If you're considering buying a home, remember to factor in not just the price of the property, but all associated costs, and be realistic about your financial situation. If you're unsure, renting may be a better short-term solution as you build your savings for a future purchase. Ultimately, the decision is yours, but it's crucial to approach it with careful thought and planning. Thanks for watching. If you enjoy this video, please don't forget to like, subscribe, and press the bell icon. See you in the next video.